Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve is trapped between a rock and a hard place, and it's creating one of the most complex trading environments we've seen in years. Core inflation is stubbornly sitting above 3%. Oil just ripped higher on geopolitical tensions, and the March 17 through 18 Fed meeting is less than a week away. Markets are repricing expectations in real time, and if you're not paying attention to this setup, you're trading blind. Let's get the baseline clear. The Fed funds rate currently sits between 3.50 and 3.75%. That's where we are after a series of cuts through 2025 that brought us down from much higher territory. But here's the problem. The Fed's 2% inflation target looks increasingly like a pipe dream. Core inflation remains persistently above 3%, and recent data is making policymakers nervous about cutting rates prematurely. Richmond Fed President Tom Barkin laid it out plainly on March 5th when he stated, quote, "With the PCE numbers that we're expecting next week, you've got a couple months of relatively high inflation. That certainly puts pause on any conclusion that we're done fighting this," end quote. According to Reuters reporting on his comments, this reflects growing concern among Fed officials about declaring victory too early. Translation for traders: the easy money policy pivot everyone was pricing in, it's not happening as fast as the market hoped. Now let's talk about what's actually moving in the inflation picture. The upcoming Consumer Price Index report that drops this week is projected to show a 0.3% month-on-month increase, bringing headline inflation to 2.5% annually. That's down from December 2025's 2.7% reading. Core CPI, stripping out food and energy, is also expected up 0.3% monthly, with annual core inflation holding near 2.5%. On the surface, those numbers suggest some moderation. But here's why the Fed isn't celebrating. Core inflation represents the sticky stuff: wage growth, housing costs, service sector pricing. These aren't temporary blips you can wait out. They're fundamental economic dynamics that monetary policy has struggled to crush. And with core inflation still running hot above the Fed's comfort zone, the Taylor rule, that standard monetary policy framework, actually suggests rates should stay put or even rise, not fall. Now layer in the energy market chaos. Brent crude has surged from approximately $72.50 per barrel to over $82 following recent Middle East tensions. That's a massive move that feeds directly into headline inflation. Gasoline prices jumped nearly 27 cents to hit an average of $3.25 for regular, according to Capital.com's March 9th crude oil forecast. For consumers already stretched, that's a meaningful hit. For inflation readings, it's fuel for the fire, literally and figuratively. This energy spike creates a specific challenge for the Fed. They need to distinguish between temporary supply shocks and persistent inflationary pressures that require a monetary policy response. Right now, with geopolitical risk elevated, that distinction is blurry at best, and markets hate ambiguity. The bond market is pricing in this uncertainty loud and clear. The 10-year Treasury yield currently stands at 4.13%, while the 2-year sits at 3.57%. That yield curve configuration tells you investors are uncertain about Fed direction and worried about long-term inflation expectations. According to CNBC's reporting on Treasury yields, these elevated rates are effectively tightening financial conditions even without the Fed moving. Higher yields mean higher borrowing costs for businesses and consumers, which slows growth and theoretically reduces inflation over time. But it also increases recession risk. Bond market pricing currently suggests investors expect gradual Fed easing toward rates near 3% over the course of 2026. But that expectation is highly conditional on data, and data has been surprising to the upside on inflation recently. If you're positioned for aggressive rate cuts, you're feeling pain right now as those expectations get pushed further out. Employment data adds another wrinkle. Jobs numbers continue coming in strong, which sounds great until you realize it complicates the Fed's decision calculus. Robust employment supports economic growth and market confidence? Sure, but it also reduces urgency for Fed accommodation and potentially contributes to wage-driven inflation. The Fed is essentially looking at a labor market that doesn't need help, which makes it harder to justify cutting rates while inflation remains elevated. Let's break down how different sectors are trading this environment in. Fixed income is under pressure. Rate-sensitive bonds face headwinds from that 4.13% 10-year yield. If you're holding long-duration securities, you're watching mark-to-market losses pile up every time yields tick higher. That's the cost of the Fed's inflation fight. Equities are showing selective strength. Technology stocks have posted modest gains despite broader market caution, suggesting investors are picking spots ahead of the Fed meeting. But rate-sensitive sectors, utilities, certain financials, they're facing real headwinds from higher yields. The rotation is clear: growth over value in the near term, defensive positioning underneath. Commodities, particularly gold and inflation hedges, are attracting flows as investors seek protection against potential inflation acceleration. Energy commodities remain volatile, driven by those geopolitical factors we discussed, and safe haven positioning is elevated across the board. When uncertainty runs this high, traders hedge first and ask questions later. Inside the Fed itself, there's division. Governors Waller and Moran have signaled openness to rate cuts, but others are warning that sustained inflation could require maintaining or even strengthening the current stance. This internal debate reflects genuine difficulty in the current policy environment. Traditional economic relationships aren't providing clear guidance when inflation and employment are both running hotter than the Fed wants. Futures and options markets have repriced rate cut odds significantly lower. According to MLQ.ai's March 9th market brief, traders are actively repositioning portfolios for the possibility that rates remain higher for longer than previously expected. That recalibration is creating volatility and forcing reassessments across asset classes. If you positioned for aggressive easing, you're on the wrong side of this trade. The March 17 through 18 Fed meeting is the critical catalyst. Consensus expects no rate change at this meeting, but the forward guidance and economic projections will be dissected word by word for signals about future policy direction. Before that meeting, we get the CPI report and personal consumption expenditures data, both of which could significantly influence Fed deliberations. As noted in the Investing.com CPI preview, these releases have potential to either reinforce sticky inflation concerns or provide evidence that price pressures are finally moderating. Risk assessment for this environment breaks down into three categories. First, upside inflation risk. If energy prices keep climbing or supply chains get disrupted again, inflation could accelerate, forcing the Fed to stay restrictive longer than markets expect. Second, economic slowdown risk. Higher yields and tighter financial conditions could trigger weakness that ultimately forces Fed accommodation despite inflation concerns. Third, policy error risk. The Fed is threading a needle between fighting inflation and supporting growth with minimal room for error. The trading playbook here requires flexibility. Don't marry positions in this environment. Stay nimble, watch the data, and respect the volatility. Rate-sensitive assets remain vulnerable until we get sustained evidence of inflation cooling. Inflation hedges and selective equity exposure in sectors that can pass through price increases make sense. And defensive positioning with proper hedging is not a sign of weakness. It's smart risk management when the Fed's path is this uncertain. The resolution of this dilemma depends on incoming data, specifically inflation measures and employment trends. Until we get clarity, markets will remain volatile and hypersensitive to every economic release. The Fed's inflation mandate is colliding with growth concerns, and how they prioritize between those competing objectives will shape market dynamics for the rest of 2026. Bottom line for traders, the Fed is boxed in by sticky inflation and higher oil prices just as markets were pricing in dovish policy. The March meeting won't bring rate cuts, but the guidance will set the tone. Position for higher for longer rates until the data definitively shifts, hedge your exposure, and stay alert to the CPI and PCE prints dropping before that meeting. This is a data-dependent Fed in a data-dependent market, which means volatility is your baseline assumption until something breaks one way or the other. That wraps your market intel. Trade smart out there. For deeper insights in real-time analysis, visit capitalcopilot.io.